And we're live. Welcome back to the Bread and Bitcoin podcast, where I talk about the future of money. I'm your host, Jamie Dabaskis. Before I move on to what I was about to say, I will apologize for the audio. It's not as good as it usually is. I'm right now using the audio microphone from my headphones because as I was recording this earlier, my normal microphone literally just died on me. It literally just broke. I'll buy a new one when I go back to college, but for now, this will have to do. So, anyways, this summer has been interesting for Bitcoin and myself included. If you don't know all this already, I haven't uploaded a podcast episode in more than 2 months because Bitcoin was moving sideways for quite a bit, and I didn't want to release my professional analysis and have it basically broken in less than 24 hours after releasing it. In addition to this, I've removed myself from the markets at that time because at that time, I felt that things weren't looking too good for Bitcoin in an intermediate time frame. Obviously, as we see now, I underestimated it. I'm wrong. It's okay. We move on. In the time being, I finished a macro or microeconomics course over the summer online. And after that, I pondered on the idea of I was looking at a Bitcoin chart, and I usually use Bollinger Bands to accurately identify the spread between, or I use Bollinger Bands to see the spread between them and to basically visualize volatility. And I liked to see how wide the bands were and put that in relation to, oh, this is the widest it's been in 6 months. So I wanted to create a TradingView indicator to automate that for me. So I'll show you right here real quick. I created one, and I'm pretty proud of it. It's nothing super fancy. So basically, in an effort to create this, I quickly learned PineScript, which is the programming language that TradingView uses, and created my own version of this. One problem I saw with it right away is that it was showing dollar amount spread, and since Bitcoin has risen substantially over time, I couldn't compare the spread in relation to other spreads. So I divided the spread divided by the current price, and obviously Bitcoin is such a high price, so you get a crazy low number. So I just multiplied that number by 100. So this is the result. You get like a little indicator to visualize upticks in volatility right here. Obviously, this is on a whatever hour chart. But I learned PineScript, and obviously, as you can see, I didn't know that there was a function already for this called Bollinger Bands width. How dumb was I? Uh, it's all good. It's all in fun. So I just revised my code just to include that function, just multiply it by 100. And just coding this, I had more fun than I should have in programming this, and I liked it a lot. So I just decided to either improve on the indicator like I did here to make it look nicer. And then I started pondering on the idea of not just making indicators, but making actual algorithmic trading strategies. I knew that I knew Java, so I have a basic programming experience, and I know basic technical analysis. So why not combine the two and make a goal for myself this summer to try my best to create a trading strategy. So I made that goal for myself, and I wanted to make it public, so I decided to create a blog, blogging my process and my learning strategies, not just strategies, but what I read, what I did to learn into how to get to this point where I am today. I'm not an expert at it at all. I'm about to create another progress update tomorrow since I just did a bunch of coding yesterday. So yeah, here's the blog and the link. I'll put the link in the description below if you want to see it. It's algocodingprocess.blogspot.com. I've been updating it whenever I make substantial progress, and pretty much, like I said, tomorrow will be another update, but that will be not really a final update, but one of the last updates in a while since I am going off to college in 2 days' time. So yeah, I've been doing this blog for about 3 to 4 weeks now, and I've already learned Python, how to import and visualize financial data with Python, and I created a decent trading algorithm in TradingView and converted it to Python, and I was trying to import it into QuantConnect. So I'll talk about my more in depth about my progress tomorrow on the blog, but I just wanted to show you what I was doing instead of doing this podcast. So with all that aside, let's take a look at why I think Bitcoin is performing the way it is right now. I can't believe it can be easier explained. I believe it can be easier explained now than 2 months ago in my other podcast. So this is going to be a little lengthier podcast because I have a lot of details to go through. But basically, starting off, since the last episode, Bitcoin has increased substantially right here, this little uptick, from our little range that we're ranging last episode from like 10,500 to 8,000. We were bouncing between that, going sideways. Broke above 10,500 resistance and then tried to break above 12K resistance. We did so briefly, and now we're pulled back to where we are right now. That's a little summary. But one thing I want to point out is how similar these two patterns are in the green triangles. As you can see, Bitcoin after the COVID crash down to 3,800, had a little recovery from a sharp drop like that, had a resistance at around, 7,300, 7,500. Once we broke above that, we tried to go to next resistance, which is 10,500, which is the same resistance as back in early 2020. And had a hard time breaking through that. It touched 10,429 on Bitstamp data right now. Yeah. Touched as high as 10,429 and was rejected super, super hard. By then, it was just going sideways for a few months, and it was messing with everybody, including me. So as I was trying to figure out a Elliott wave count of how to basically quantify this trend and how I can best navigate it, it was just confusing me. So I took a step back, let Bitcoin do its thing, which is basically go up. Yeah, so this little pattern I want to share is I'm going to go on the 4-hour chart to see the divergences. But basically, it's very, very similar to a nested wave 3. It's like a wave 3 of wave 3 of wave 5 of it's so nested. So it's like almost 3 of 3 of 3 of 3. As you know, wave 3s and Elliott wave are the fastest and strongest waves. So obviously, that's going to be a substantial move. So you can see wave 3s to wave 5s usually have negative divergences, which means that as price goes higher, the indicators get lower highs. You can see that right there, making it seem that this is a wave 3 of 3 right here, and that this is possibly a wave 5 or wave 5 of 3, looking for some massive consolidation right here. I'll explain the Elliott wave chart in a bit. Yeah, I'll just pull it up now. So here's my Elliott wave chart for Bitcoin of what I've figured out so far. My primary account is in green right now. This is all under the assumption that the COVID crash right here was the COVID crash from the 14K top back up here, that this is a big 1, 2, and this is supposed to be some bullish impulse off the low of 3,800. That's all assuming that that's a wave 2. If that's not a wave 2 and that's some gigantic B or gigantic A wave looking for a B higher, that means we could technically see new lows. That is not invalidated yet, but it's less and less likely the higher we go. So it's less and less likely right now, as I would say. Do keep in mind that Bitcoin likes to have extended wave fives. So if me predicting that we're in some wave five, it could just keep extending and go a little bit higher. In that case, if Bitcoin was to go a little bit higher, I expect my little purple box right here, which is around 11,000 to 10,500, I expect that box to hold. If we don't hold that, that is the first sign that this local top that we just had is a bigger local top, looking for a healthier or healthy pullback. And what I mean by a healthy pullback is I don't want a deep pullback like COVID crash, even though I do think the stock market is looking pretty dire. But after COVID crash, I feel like a lot of Bitcoin people are going to try to make sure that either A, it doesn't happen again, or B, just buy the dip and just suppress such a downward move like that. So I would like to see a shallower wave two down to 23.6 to 38.2% retracement. Anything lower than that, then it could shake out a lot more people. Technically, a wave two could go all the way up to 78.6. Anything below that, so basically, if this starts to become a bigger pullback than expected, anything below 5,000 is alarm should be going off. That means we probably could see new lows below 3,800, and that would not be good to see. So yeah, I have the green count's my primary account. The blue count right here is an alternate wave three, so either counting the main wave three right here or saying it ended right there with that final fake out right there. Basically, we had a similar fake out right there at when we broke up to 10,400. That's why it seems so similar to me, just looking at these two things. I'm not crazy looking at these two patterns. Yeah, but anyways, if things go south in all markets, I think Bitcoin could see a deeper pullback, but hopefully not below 5K. But the reason I don't think it can go below or 5K and have that deep of a pullback is because the only difference between this pattern that I keep pointing out, this pattern happening now versus the first time it happened, is because, let me pull up a one-day chart. This trend line from 20K touching 14K, that big important trend line that a lot of people are eyeing, we broke above it explosively. We broke above 11K and then 12K. So that's a longer term signal, and it's got a lot of people more bullish than usual, more bullish than the first time the pattern happened. So this general change in sentiment, as you can see in this crypto fear and greed index, is having everybody extremely greedy. We're having a lot of new people into the market. Dave Portnoy entered the market. I was kind of imminent at the way that he was day trading and stuff like that. But you're seeing the summary is you're seeing a lot of popular people, and you just, how do I explain this? I personally have been getting messages from people that I don't necessarily haven't been talked to in a while, and all of a sudden they're asking me for stock tips and crypto tips. And I keep telling them the same, the amount of upside relative, there's more risk for the downside than there is rewards for the upside at this current moment. So for those who don't know, sentiment indexes like this one range from 0 to 100 with extreme bullishness either at 80 or 70. This one apparently is at 70, and extreme bearishness at 20 and below. This is generally read as extreme bullishness as potential topping indicators and extreme bearishness as potential bottoming indicators. You can see this indicator lines up with the March drop. As you see, we weren't overly bullish because we didn't break above that important trend line. So it's around 60, wasn't like super extreme levels, but it was like around the mid range. And then once we got that COVID crash, we dropped to as low as 8. So you see that intense drop in sentiment. Everyone's like, oh, it's going to 0. And then we recovered. And now we're in extreme levels because I believe we broke above that trend line. And also because money printing and all this stuff that people believe gives Bitcoin value. Going back to those two similar patterns, because of this drastic change in sentiment since the last time this pattern occurred, this can mean that we could have higher volatility. Let me pull up this one. We could have higher volatility. Obviously, this pattern isn't occurring at the same speed as this pattern. This one's a lot more drawn out and more, the moves are a lot slower. I mean, yes, an 8% move in a day is pretty fast for normal markets, but for Bitcoin, it's just a little correction pattern. This one we saw a 6% move in one day, and just this pattern is happening a lot faster because of the higher volatility, I believe. So yeah. Now in the meantime, which I'm leaning towards, Bitcoin could play out sideways before either trying to push higher or lower. You can see my little purple support box that I drew right here. In the non-Elliott wave one, but not the same one as the purple support box in the Elliott wave one. My little purple support box, I expect it to bounce off there a couple times. It is based off of this support box that we bounced into it like 5 separate times. So I expect it to bounce between 11.3 and 12K resistance. Maybe bounce there and go sideways for a bit to let everyone cool off. Yeah, I expect it to bounce up and down this box for some time until price action says otherwise, pretty much. And another set of indicators, which I want to show, is the DeMark indicators on a daily Bitcoin chart. For those who don't know, DeMark indicators are a way of measuring how exhausted a trend is to accurately identify points in the trend when the said trend is the most quote-unquote exhausted. This chart I'm showing here is courtesy of Thomas Thornton. If you don't know who he is, you should go check him out on Twitter at Tommy Thornton. I will put his Twitter link in the bio. I'll throw it up on the screen. He runs a website called Hedge Fund Telemetry, where you get to sign up and gain access to his insights in stocks, bonds, currencies, commodities, and more of using DeMark and other technical indicators. He is seriously good at what he does, and he's an expert in applying and interpreting DeMark indicators to almost any chart. I've been following him and learning DeMark indicators from reading his content. I'll include his Twitter in the link. I'll include his Twitter in the bio and his link to sign up to Hedge Fund Telemetry in the description below if you want to learn more. But if you don't follow him on Twitter, you should do that at the very least. Anyways, his Bitcoin DeMark chart right here on the screen, and you can see DeMark trend exhaustion indicators pinging with TD cell sequential 13s and combo cell countdown 13 signals. Well, what do these signals mean exactly? A TD sequential is comprised of 2 separate parts, a setup and a countdown. A sell setup occurs when there's 9 consecutive bar closes, with each close being greater than the close 4 bars before. While the buy setup is the same logic but the other way around, 9 consecutive closes, lower than the close 4 bars before. After the setup, there is what's called the TD countdown. A TD sell countdown occurs after a sell. Hold on, I can't see. I don't have my glasses on. Yeah, countdowns. TD sell countdown occurs after or can start on the setup 9, where the close occurs greater than or equal to the high 2 bars earlier. Countdowns start at 1 and count to 13, but don't have to be consecutive like setups do. So once the setup and countdown completes, you have a TD sequential signal. So now what is a combo countdown? A combo countdown is a little more tricky by having more requirements to fill. So when they do occur, they should be taken a bit more seriously than regular countdowns and setups. So a sell combo requires a close greater than or equal to the high 2 bars earlier, plus each high must be greater than or equal to the previous bar's high, plus Each close must be greater than or equal to the previous numbered close and non-numbered close. And TD combos also count to 13. That was a quick explanation. If you can quickly listen to what I said and fully get that, I applaud you. But that was supposed to be just a quick overview of the market indicators. I'll include some links to some good research PowerPoint to go through. So now it's easier to read Thomas Thornton's Bitcoin chart. Now you can see that when Bitcoin first broke 12K right here, Bitcoin had a TD sequential sell countdown 13 after it set up 9 right here, and also hit a combo countdown 13, and is now hitting more countdown 13s, further indicating the trend is exhausted. But obviously, Bitcoin loves to extend far past anyone's beliefs, and the market indicators cannot be used alone to determine trade opportunities, and this applies for all indicators. Small side note, if you rely on only one signal, the odds are heavily stacked against you. That's why I'm showing several indicators and that I've learned and or methods of analyzing charts so you can make your own interpretation of what you think or what you might think happened. Anyways, in order for these sell indicators to actually have an effect, you would need what's called a price flip down, where the price goes lower, destroying all the requirements needed for extending these 13s and 9s and stuff like that. You can see the price flip down when Bitcoin was rejected hard from 12K, but then continued to extend the count up to 14K, or not 14K, 12.4K. Although we probably do have a price flip by now since Bitcoin has pulled back from 12.4K and this chart is a couple days old, yet still valid. Thomas Thornton also says in this latest chart, in this little text right here, if you've been reading while I've been talking, he says that he has more confidence in a move down if Bitcoin breaks below the 20-day moving average. Let me show you where we are currently with the 20-day moving average. Yeah, so this is a 20-day moving average, and we broke, closed, and are currently below it. So based on that, Thomas Thornton is more confident that we'll see a move lower. Yeah. So potential short-term patterns aside, now let's get into my current market outlook. Pull this up. Oh yeah, big scary headlines. One thing I have to address as to why I'm generally trying to call a top in Bitcoin these past few months and failing is the reason as I'm antsy about this and that the US economy doesn't look in that good of shape. As of recently, the US has gotten its change in GDP data for how much COVID has had in our economy, how much impact COVID has had on our economy, and it isn't good. Like most expected, it's just that the data takes time to compile to see the effects. Here is a little chart. Let me see if I can expand it. Oh yeah. So we have the worst drop in GDP quarterly data, like ever, like worse than all the recessions before. That is like a big alarm to me that for basically in unprecedented times, no one's ever seen this before. And yeah, it's just really irking me. And what's really irking me about this is that despite this, the entire stock market is being dragged up by the 6 biggest tech companies in what superficially appears to be a tech bubble that keeps inflating. Now, this tweet I made a while ago, August 1st, so 20 days ago, 22 days ago, since as of recording this. But I was just talking about how amazing 5 stocks, Apple, Microsoft, Facebook, Google, Amazon. There's other ones like Netflix and other ones, but these are the most like prominent American tech company brands that everyone in the world knows. It's like if the rest of the market can pick up its own weight, then maybe it isn't as bad as I think it is, but the divergence between FANG, which is Facebook, Apple, Amazon, blah, 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 and everything is wide now, just like Axel Work's tweet right here, you should take a look at. If you don't follow Axel Work, you should. He's a really good trader. The reason the new technology is always crazy pricey is because it's difficult to quantify how these innovative technologies are worth. There's a reason everyone went euphoric over the internet bubble in the early 2000s, because no one knew how much a how much impact a website could have on the mass market of consumers. Obviously, now we know that some of those biggest websites now control basically the world. It's difficult to put a price on how much these simple either computer applications or websites, like I said, can radically change how consumers can basically consume, whether it's through ads, whether it's through a different way of buying products, whether it's a different way of pretty much anything. I mean, who knew of a video sharing app like TikTok, where you share just like up to 1 minute videos, can grab 800 million active users globally and is now seen as a security threat? I mean, it's just crazy and wild to me. There are people that say Bitcoin. Now, how does the stock market relate to Bitcoin, you might ask? There's people that say Bitcoin isn't correlated to the stock market. So why does a potential tech bubble matter to Bitcoin? Generally speaking, as you can see in this chart, yes, people are right. Bitcoin is generally not correlated to the stock market. As you can see, these are Pearson correlation coefficients between Bitcoin and the S&P 500 since back as far as 2011. And it's a rolling 180-day correlation. So correlation coefficients range from 0 to 1, or -1 to 1, -1 being an inverse relationship, and 1 being a positive relationship or correlation. So reason I bring this up is Bitcoin has typically never had a noticeable correlation to the stock market. You can see it basically oscillating around 0. So it's pretty much, this coefficient doesn't really, people shouldn't really pay attention to it, or shouldn't really, like, it's not like a big deal to most people because it oscillates around 0. There's no correlation. But as you can see in this chart towards the right, it's just skyrocketed since the COVID crash, because everything is just being lifted up with printed money pretty much. Or actually what that was called is a liquidity crunch. Liquidity crunch is simply when most investors start to see a crash and they start to cash in on everything. Even investments that are considered a safe haven, like gold and commodities and Bitcoin, to gain access to more liquidity to, quote unquote, weather the incoming storm. Obviously, I said that if investors start to see a crash, then a short-term liquidity crunch happens across all markets. But Bitcoin is still trending up, so why do I see a correction in Bitcoin? Before answering that question, first let's look at the disparities between the perceived health of the stock market and the actual health of the stock market, and how a crash in the stock market could possibly affect Bitcoin. Moving to a chart of the S&P 500 on a monthly chart. So this is long term. You can see here's the dot-com bubble of 2000. Here's the housing market crash of 08. And that's a little COVID crash right there. As you can see, steady growth, I'm going to take a paint tool. As you can see, steady growth in price, and the steady growth usually corresponds to steady growth in indicator values. And that's all rainbows and butterflies. It's all great. But sometimes there are disparities between the two. When price continues to go, this is specifically in RSI. Let me get rid of MACD. When price goes higher, indicators go higher, it's all sunshine and rainbows. But when price somehow continues to go higher, while indicators get lower, that's a negative divergence, and it's not a good thing to see, especially in longer time frames like monthly and weekly charts. And obviously, if you're seeing where I'm going with this, you can see, and before I show the COVID crash, you can see increase in recovery since the '08 crash, increase in indicator values, sunshine and rainbows. Everyone's having fun. But when price continues to go higher, well, indicators go down currently. Not a great thing to see, I'll tell you that. Not a great thing to see. But also look near the top of the early 2000s tech bubble and see how they acted the same. So I'll show you the dot-com bubble, the top 10 companies in the world, a handful of them were tech companies: Microsoft, GE, Cisco, Intel, Nokia, Lunsen, I don't know what that is. Yeah. So majority of them were tech companies. Now let me pull up companies, top 10, 100 companies right now. 2 trillion, 1.6 trillion, 1.6 trillion, 1 trillion, 1 trillion. They're all tech companies. So Berkshire Hathaway and HSBC Holdings. Tesla, 1,000 PE ratio. This is just getting absurd to me. It just feels the same, even though I wasn't alive. Well, technically I was alive for '00 crash. I wasn't alive for the run up, but even though I wasn't here to comprehend the tech bubble crash, it looks similar. I can't say it feels similar because I was only like 1 years old, but yeah, it just looks so similar. So if the S&P or SPX, here's my Elliott count, which is similar to Bitcoin, which we're nearing a topping zone, but could go a little higher. It's just that with Bitcoin's increased volatility, we could see Bitcoin go a lot higher before pulling back. So if the S&P 500 appears to be nearing the end of its run up from the March bottom, going back to the question I asked before, if Bitcoin is still trending up, why do I see a correction in Bitcoin? I hate to delay the question again, but again, before answering this complex question, let's take a look at comparing Bitcoin, stocks, and bonds to the dollar index DXY. While gathering all the information required to make this hyper detailed podcast episode, my dad pointed me to one of his books, Intermarket Technical Analysis by John J. Murphy, to read a specific topic in it about the relation between commodities and the US dollar. The main point I wanted to share is a direct quote. A falling dollar becomes bearish for bonds and stocks when commodity prices start to rise. Conversely, a rising dollar becomes bullish for bonds and stocks when commodities start to drop. This section of the book also points out that turns in the dollar eventually have an impact on bonds and an even more delayed impact on stocks, but only after long lead times. So that begs the question, are we in that long lead time right now? Because basically what that quote means is that there are predictable setups between stocks and bond markets, but the reaction in those markets aren't as an immediate response to those drastic changes in the dollar. And what I mean by drastic changes in the dollar, let me show you. Where's my other SPX chart? Yeah, right here. Let me pull up a daily chart and see that choppiness. And right here is the DXY. So this is the index of how much the US dollar is worth. I'm going to change it to white real quick. I don't know why I didn't do this before. Yeah. So, oh no, I was supposed to pull up the Bitcoin chart first. Yikes. As you can see, after Bitcoin had its little nice multi-month rally from low 7Ks over here to 10.5K in early 2020, had a nice rally. You can see Bitcoin start to correct, start to fall above the this trend line right here in white. Didn't quite reach that, so it's starting to correct a bit. You can see the dollar falling with it as also like the SPX was. Where's that chart? When the SPX started to fall a bit, the dollar started to fall with it. But when the fall accelerated, aka the actual crash, is when the dollar just skyrocketed in value. So that was the liquidity crunch. That was the flight to US dollars, everyone selling everything in panic, pretty much. Everyone selling everything in panic. So yeah, you also see the same thing in bonds too. Blue is bonds and white is dollar, just for reference. You see the same thing in bonds. Bonds start to drop a bit and the dollar drops with it. And all of a sudden, once it actually drops hard, the dollar skyrockets in value. But if Bitcoin hasn't started to correct, how can a short-term liquidity crunch be plausible? Let me turn this off. Well, just like the quote from the book said that a falling, I need that quote. Just like the quote from the book said that a falling dollar is bearish for bonds and stocks when commodities prices start to rise. Let me say that again. A falling dollar is bearish for bonds and stocks when commodity prices like Bitcoin start to rise. So that's why it increases my confidence for a potential top in the S&P 500. But leading this back, since the S&P 500 has an increased correlation with Bitcoin, if the S&P 500 starts to correct, then Bitcoin could possibly correct. That was the flow of thoughts, I guess I was trying to explain. So yeah, I mean, if the stock market crashes hard enough, there could be another short-term liquidity crunch causing an asset like Bitcoin to correct itself. But like I said before, I don't expect Bitcoin to drop as hard as COVID or drop below, making new lows. I do expect new lows for the S&P 500 though. So yeah, a short little summary of my outlook on Bitcoin. After all of that long explanation, in the short term, if Bitcoin, pull up forever, if Bitcoin can surpass 12,400 again, right here, then we see a retest, or you can see a test of, oh shoot. We see a test of this top resistance zone, 13 or 12.9 to 13.9, 13.8K. And just round up because people see it as a psychological resistance. So probably if we can break above the local high, bouncing off that purple box, we could probably see 13 to 14K. I don't see a doubt about it. Otherwise, we might see some sideways action for now, or a healthy pullback considering the strength of the uptrend in the stock market and pretty much all markets, not just stock market, all markets. If Bitcoin was to go higher, I'd like to see Bitcoin's daily MACD surpass the previous high right here, get new highs, because getting new highs in price without getting new highs in MACD, like I said, it's a negative divergence. It's not something you want to see. But yeah, in the intermediate to longer term, if the stock market pulls back substantially, we could see another Bitcoin crash, but there's no possibility of new lows. I don't think so. Unless this is not seen as a wave 2, it's seen as a wave A. That is the caveat. But the higher we go, the less likely that is. It's not invalidated yet, though. So that's all for episode 27 of the Bear and Bitcoin podcast. I know it's long and detailed explanation, but I felt the need to say all this because things weren't making sense to me the past few months. Give the video a like and subscribe if you liked the content. Oh, my glasses. Like and subscribe if you like the content. Follow me on Twitter at JanieDabascus. Also, big shout out to Thomas Swerton for letting me use his chart. I'll I'll put all his links in the description below. You should at least follow him in the very least. Yeah, peace out.